With you and I talked a little bit about intelligent debt management, evolving, having cash, thinking about investing, potentially in finding tech solutions. Can you elaborate a little bit more for our audience on that?
Sure. Maybe just a bit of an introduction, because it's not, you wouldn't necessarily think we should be on this panel or, part of the participants. What we do is manage people's debt and get them out of debt and hopefully make them stay out of debt. Now, debt follows money, and of course, money means fin, so it's quite a nice link. But the point is, we've helped over about 40,000 people get out of debt and hopefully continue to get out of debt. And one of the things that we see, which technology is moving so fast, is of course we have some hurdles when it comes to regulation and all of that. But one of the biggest challenges that we see is there's a lot of investments and innovation that's happening in credit space, in granting of credit. Giving individuals credit, but we also know a certain section of those people will never pay back the money, either part of it or none of it. We know that. And what we haven't seen as much is in terms of innovation from the debt space, the debt collection, and what we do is debt counseling, debt management. We're seeing some interesting debt management tools pop up like Kudo and Credit Karma and so on that you would have seen, allowing people access to their credit reports in real time and so on. But we really are looking for sort of debt management type solutions, the end-to-end, that don't seem to exist as much as credit granting.
Perry, you've worked with fintech startups all over the world. You're an Englishman who's seen the light and lives in Cape Town. But your thoughts working with both fintech startups and advising into corporates on what the future holds for investing in fintech? You've heard some interesting speakers. You've heard the banker. You've heard the angel investor.
Yeah, I got subtly shifted to the corporate panel from the principal panel, which is dangerous because I'm an entrepreneur. I built one of the businesses on Nicole's little unbundling a bank, and I used to sit on the board of her unicorn that she talked about, and I work with a venture fund. And corporates is just about the topic I shy away from as far as possible, because my experience as an entrepreneur and building these things is, somebody like Paul is just a godsend for entrepreneurs, honestly. And the attitude is fantastic, and then the delivery and execution means it's often, to your point, more of a challenge than it is a benefit to partner with corporates and institutions. So it's a really tough one, because people say, what would you do if you're an institution? The truth is, I don't honestly know, and I'm glad it's not my problem, if I'm really honest. As venturing goes, though, to the point about venture, I was just going to make two minor points to your question about sort of corporates and venture. One, and I was told to say things that are generally a bit controversial. One of the big things that's sort of a bit controversial generally, that's a bit of a problem with this sort of environment, is the big misnomer in all of this is fintech. So to an extent, as you'll probably know, all fin has always been tech. Money's a pretty efficient technology as a store of value. If I were a bank, I'd be pretty pissed off at this point, because I'm like, we've had ATMs, we've had all kinds of tech all of this time, and to do anything at scale and volume as financial services go involves tech. The rate and pace of innovation, though, is definitely pretty significant, and it's very damaging if you're running it as a big monolithic institution. So the challenge is, even some of the startups that I know and have worked with and for, at the point at which they get too big and unwieldy, it's hard to act and behave like you're small and nimble and can change and alter and move. And what you're needing to do, the other thing I was going to say to Paul's point, a lot of the web businesses, what they're very good at, and the corporates struggle with, is that they really are truly customer-centric. It's not like they're saying they're customer-centric, but if you've ever worked in a startup that's incredibly good at being customer-centric, I start with a customer and I work back. I don't start with a product and my organization and my complexity and my detail. I sort of start with a customer and I deliver sort of backwards whatever it takes to whatever they need, and in the long term I win. And that's very hard to reinvent yourself into. So as corporate venturing, I'm sort of going off on a bit of a tangent, but as corporate venturing goes, I work with a venture fund, a European venture fund, and the big investor in that fund is MTN. And so MTN put $75 million into this fund. And I have to say, as it goes, the further that they can leave this thing to some extent at arm's length and partner with people who are part of the ecosystem and are able to be nimble and quick, definitely the better it is for the institutions, in my experience. Because what happens is, usually they these things, they want to get very involved and get their hands around it, and then a couple of years later, the organization's changed and the people involved have changed and the whole thing's different, and then it hasn't gone as fast as we thought, and then there's a new plan, a new strategy. So it's hard to do stuff effective for the long term.
Cobus, you lived through that very experience as a co-founder of SnapScan. What would you give to people who are in the room thinking about a new idea or looking to break the bank, given your experience?
Well, if you're a small startup trying to break the bank, you really need a better business plan. I think banks get a lot of slack that are unjustified, or that is unjustified. Banks are really efficient at what they do. I fully agree that banks probably shouldn't be doing the things they are doing today 10 years from now. That would be catastrophic. But I think it's very easy to sort of bash big finance, or whatever you want to call it. It's been an interesting journey for us, and we're sort of a group of companies working mostly with corporates. And I think the reason we do that is that the South African funding space makes it very hard to build good companies if you need to go ask for funding on day one. Right. It is a challenge. So our approach has always been some kind of complicated hybrid model where you start to generate revenue, not necessarily from the end product, but at least through your relationships as quickly as possible. So that the culture that we have is one that's closer to bootstrapping than it is to funding. It's interesting. So I think you're right. All good large corporates today are trying to do this, whether it's in internal innovation programs, whether it is setting up funds or accelerators. I suspect the really hard thing is to figure out how you use those programs in a way that actually generates value for the corporate. I suspect in fintech specifically, all of the banks essentially are busy running programs like this. There are massive amounts of international companies doing this, VCs are doing this, large PE funds are doing the same. And there are not enough good startups to go around, to be honest. And I think what happens then is the entire market gets retarded quite badly because the people who are excellent and have good businesses tend to prefer to build those themselves first, because then they're in a better negotiating position with a large company. And a lot of not well-developed startups get put through programs that they're not quite ready for. And I think finding that balance is a really hard one. I'm absolutely not knocking any of the programs. They're crucial for building the ecosystem. But it is a difficult one when we don't have a long track record like Silicon Valley or certain parts in Europe.
Maybe I could just jump back to you, Perry. South Africans are notoriously risk-averse. And so if you turn up anywhere as a South African and you say, I failed at something, usually that's a cross against your name. We don't celebrate failure. We don't celebrate risk-taking. Do you think that that's stunting our fintech opportunities and the development of good ideas and businesses?
Well, that's a difficult question. I don't know. I mean, I'll answer that directly, and I was going to come back to Cobus's point, which is absolutely right, where the knee-jerk reaction for a lot of corporates that I've seen down here is, well, we've got to do something. Let's start an incubator or an accelerator, and we'll invite people in, and we'll run a program, and you'll benefit from our largesse and our great network and our fabulous whatever. And the truth is that typically with incubators and accelerators globally, when you look at them, the ones that work, like Y Combinator in the US, is the ones where the entrepreneurs want you, not they need you. If they need you to survive and they don't survive without you, then they don't survive after they leave you. Y Combinator gives you a very small amount of money, $5,000, $10,000, but you want to be part of that network because you're going to benefit from the network effect of that. Right. And the ones elsewhere in the world where the dependency is I need you for your money and your skills and your resource, the truth is when I leave you, I don't survive without you and your skills and resource, and so who's going to fund that and sustain it? So I do think there's a sort of short-termism in this sort of starting incubators and accelerators. It may be a cultural issue, to your point, that there are lots of sort of risk-averse people, and so they'll feel more comfortable moving out into something that's a semi-structured environment. That hasn't been my experience of South Africans. So actually, I have to say, I haven't seen, in the UK where I live, or in Europe, you don't have a culture of failure either. I mean, it's not, and even in the US, actually, I have to say, I don't know how many US entrepreneurs, they don't all come out feeling great about failing and not succeeding. So it's a bit of an overstatement here, I mean, I've met lots of, I mean, these guys, awesome entrepreneurs, could be doing plenty of things and well paid and are happy to take risk. I think the big issue for me with some of the entrepreneurs here is not so much about risk, but it relates a bit to Nicole's point, which is the world of venture and the world of corporate venture. What a lot of people don't appreciate about venture as an asset class is there's a spectrum of things you can do, from put your money under your mattress all the way to walk into a casino. And venture is right up at the risk-reward end of a casino. It's not a safe reason to get your money back 3 times. It's a very small chance of something very big happening. And I don't care if 1 in 10 of you is going to go to the moon, and 8 in 10 of you, 9 in 10 of you are going to go home, and maybe one will sort of break even. But that's my economics of getting 3 times my money. And so the issue here is not so much about propensity to risk, it's the size of the opportunity and the degree of risk that people take here, so to Nicole's point. The opportunities here, as venture goes, just generally aren't big enough. And so a lot of the entrepreneurs, it's not that they're risk averse, it's just that they don't start things that have enough potential to make the economics of it work the other way. The issue with venture here, and I don't know if Nicole sort of knows this, is Africa, when you come down here, it's sure there's all this macro story, there's 7 of the 9 fastest growing economies and growing wealth and growing urbanization and growing this and growing that, and the GDP of the continent is smaller than Brazil. It's smaller than Russia, and it's 50 countries and 2,000 dialects and fragmented wealth. So how do you do shit that's big enough for venture to say there's a small chance of something very big? It all happens on the West Coast because California is the 7th biggest economy in the world. And if I win California, then I don't even need to do the rest of the US.
It's not every day you get 3 guys like this in one place. Comments, questions? Oh, they're opting out here. Benai, how does somebody get hold of you? Somebody sitting in the room and says, we've got a great idea around debt management. We're thinking about, to Perry's point about, we want them, we want to be part of what they're doing. How does somebody reach you? You know, there's LinkedIn, but what do you want when that organization or that business or that entrepreneur comes at you?
Yeah, I mean, just to put some numbers on the table, we know there's 10 million people in this country who are not paying their bills and everything else regularly, okay? That's 10 million people in arrears. We think out of these, 3 to 5 million are actually incapable of making months end meet. No one will come out and tell you, hey, I'm having difficulty. But we really need solutions for these guys. They're really struggling. And the thing is, there's always a stigma attached, kind of like the failure. No one is going to walk into a shop and say, hey, I've got massive debt, can you help me? It's difficult to find these guys. And you know what we desperately need is actually innovative solutions in fintech space to try to get a hold of these guys, but also offer solutions to them. A lot of them are really crying for help. So our flagship is Debtbusters. You can go to our website, debtbusters.co.za. And some of you have heard our really catchy songs on the radio that are very cheesy that we played over the last few years. I'm happy to stick around. We've also got a few colleagues here who've got the brochures and stuff. If you want to get a hold of me, I'm the only person with that name on LinkedIn, thanks to my parents. So it shouldn't be terribly difficult.
Okay, I really appreciate your time. There was a comment? Oh, good.
Once since started the engagement with Standard Bank, how long did it take for that to start giving results, like actual adoption from their customer base? And how long did it take from that then to turn it full throttle?
The full throttle part is currently ongoing. So Standard Bank's an interesting one because I obviously can't speak on behalf of Standard Bank, but they very specifically embarked on sort of an innovation focus. It has a lot of components. One of the components is absolutely creating partnerships with external parties, but a lot of it is actually internal reimagining of business and processes and a lot of things like that. And I think it is the same for Standard Bank's one example, but we've worked with a number of large corporates in South Africa, and the story is quite often the same. What is scary, and luckily wasn't the case, and I mean that's one of the things which would be a red flag for me, but what is scary is quite a lot of companies essentially treat venture capital as insurance, which to Perry's point is essentially exactly the opposite. Right? So they go, okay, so the world is really scary. There are all of these people disrupting us.
Totally
Uber may replace banking. So let's just throw a little bit of money, the same we spend on stationery. We'll throw that at sort of small companies in South Africa because they're working on cool things. The reality is, if you try to future-proof in that way, you are doing exactly the opposite of what makes sense. Because what happens then is the company grows, you get a really nice product, and then you have one or two options. One is relinquish control completely so that it becomes a market mechanism funding this business, which means your competitors are probably going to be participating, if you're a large bank, for example. Or the alternative is internalize it in some way and make it part of your business and allow yourself to be cannibalized and disrupted, because at least you understand that. But that looks great on a pitch deck that goes to the board. It's really hard in practice. Yeah. So if you sort of disruption is a horrible word, because I mean this is also not new, but the effects of it and the time frame of it is incredibly new. And a large piece of, to Paul's point, I think a large piece of what banks, in my view, and I mean I have a very slanted view of banks, but my specific opinion on what banks are good with today is essentially trust. It's one of the big reasons we're working with a bank is to say, look, it's not a fly-by-night company that's going to be gone tomorrow. There is a sort of a reputation that goes along with it. But that means that banks, by their very essence, they're large companies. And they are going to move slowly and provide that reliability and that stability. And reconciling that with drastic disruptive change is super hard. So, I mean, for us, it was an interesting story. I mean, we started doing essentially a project I mean, we built stuff on our own, then we started doing sort of pilots together, then sort of formalized it, put it through the process, to where we are now is 3 years. Getting a deal signed with a bank, with a group legal division, any of them, is fun, in a very particular sense of the word. But it's not, that's not a reflection on the company so much as it is on the structure. I mean, we spend probably 1/3 to 40% of our energy on compliance, right? So we all agree probably only half of that is needed. That half is incredibly essential. But if you're playing disruption game, you have to realize that's part of the game. You can't sit and complain about it. If you want to do it, you have to sort of grow up and do the hard work.
I just wanted to add one minor point. So to that point about, you asked me culturally about an issue about risk aversion. I think the big cultural issue here is actually, which you do see in the States, is about openness and willing to help other people and anyone, not the closed, it's mine and protectedness, which you don't see here. And these guys, I don't know how many of you know Cobus, or I don't know, but the founder of his business, Ian, are exceptional entrepreneurs. I mean, they're world-class anywhere, as good as I've seen anywhere in the world. And the issue is, not that they're not building great businesses, but it's not that all the other banks are approaching them and applauding them and holding them up and wanting them to be heroes. And that's actually what happens in the States, is that more than it does, and is like they celebrate success. It's not so much about risk aversion among the entrepreneurs. It's I'd love it if the other banks were helping these guys. I mean, you have no idea how hard it is working with a financial institution anywhere in the world unless you've done what these guys do. It's insanely hard to do, and so that they've achieved what they've achieved is unbelievably noteworthy, but it's not like everyone else comes and helps them and celebrates, whereas elsewhere everyone helps because that's what you do, because it's not a zero-sum game.
I actually come from the corporate investor side as well. But going back, if I look at the Coles deal flow on VC side, if I look at that whole deal flow, that's less than what the bank's been recently on the data center. So if you're an exec, you're not going to get fined for buying another IBM data storage solution. So if I look at the billions that are being thrown on a 3-year cycle, whatever it is, like what is that inflection point period? How do we assist companies going through this journey of actually saying, instead of spending another $100 million on a data center, here's $100 million that can really change.
So the key, in my experience, is doing something and starting small. So the problem, in a way, becomes when it's this big deal and we've got to reinvent the whole bank, and then suddenly entrepreneurs wouldn't do that, if you know what I mean. If you're an entrepreneur, it's like, let's do something, let's put $1 million in the bank and lose it and waste it and buy ourselves an education and see what happens, if you know what I mean. And then that works and it leads to something. And Barclays, to their credit, did it very well, actually, when they partnered with Techstars, and then the guy had struggled to sell it through, and then he was a bit of a hero, because actually it was... So the key is do something small, not reinvent the way the whole... I personally would find that almost impossible to do, if you know what I mean. So you're right, it seems absurd from our side of the table. I was with a UK bank the other day, and the guy has 800-700 branches and the CEO of a retail bank, and he's got a $25 billion balance sheet. And I'm saying to him, and you're right, it's like, why can't you just take $5 million and maybe you've bought yourself an option in education? And it's very hard to get over that first hurdle of commitment, in my experience. But doing something small is much better than trying to reinvent and complicate the whole.
Yeah, I think.
Thank you. As soon as the noose around the neck, okay, is loosened around thinking about business as usual, because those big data centers are about core running mission-critical systems, keeping the lights on. As soon as the DNA of the organization understands that actually you've got to have, I think, 3 lenses at least, mid, short, and long. And the work that goes into the guys here in the front are in H2 and H3. When they see the world through different lenses, that's when you know the light's gone on, okay? And that talks to structure, because you've got to fulfill against that structure. You've got to have different people with different cultural mindsets and different measurement and different KPIs sitting, looking at the future. The trick is, I think some organizations get that, but what they do is it's like a leper camp, right? Those freaks over there, right? They weird, man. They wear jeans to work, right? Or whatever. Is actually, yeah, I know. Sorry. You're already in the camp. Is to actually, without teaching people psychics, is really to kind of create a formal link back into each division has that lens opportunity within each, with each department should have the luxury of that ultimately, ideally. But starting small is the key, and thinking through those different lenses.
If I can just quickly add to that, I think something that I found very interesting in banking in South Africa is that a large piece of, I think, that what is hard is the concept of owning the customer. Right? So if you talk to any of the large banks in South Africa, any of the big 5 banks, a big piece of the history has been that somebody has a primary bank account somewhere. Now, and that essentially boils down to whatever product gets launched, you can sort of, if you're executing well, you can assume you're going to get 20% of the market, more or less. So you can build your financial models on that. What is interesting is if I think about the space we're in, and fintech is problematic as we've discussed today, but if I think of the space, all of the banks in South Africa and in the rest of the world together is less than 20% of the things I worry about. So the entire parameters of the environment is changing, not only the reconfiguration within that space. And that on the one side is really scary, but on the other side means it's not a zero-sum game, which is quite a nice kind of game to play, because you can have more than one winner in that setup. But I think that mechanic is a very new one, and a very strange one, and one that is unusually strong in in fintech or in finance or in banking. Whereas if somebody is building a new e-commerce store, they just assume more people will buy from them rather than who am I stealing customers from. And that's a very interesting sort of meta dynamic on the space, because a lot of sort of large banks, insurance companies, corporates generally, also misunderstand perhaps what the motivations are behind small companies like ours that come up with a new idea. So when we started the company, the goal was not let's go find the best bank to help us. It was, in the entire world, there are many ways to solve this problem. Getting the money is actually not the hard part. So it is a case of, if I'm going to work with a bank as a partner, what can they actually offer that isn't money? Because the terms for the money isn't going to be good anyway. There are a lot of, VCs will give you money on better terms, easy, and mostly international VCs, not South African VCs. That's a lot harder. But if we happen to have an office in Palo Alto as well, and getting money there is a very different game. You sort of walk down the road and speak to some people, and then 30 days later you have a term sheet. Closing, it's a different story. But so I think it is about really looking at what your assets are, and it's not just cash. If a financial institution today can actually give you access to the tools and the assets inside, then they're unbeatable in the space, but only if it's accessible. If you've got the most awesome systems to issue loans, but you're not willing to have anybody look at what your business process looks like, then it's useless. In fact, it's worse because you also won't allow me to speak to anybody else about it. So I think that's been a lot, and I mean, we've made some nice choices in terms of picking a partner, so I'm very happy there. But I think that's a big challenge generally, is what you put on the slide deck for exec and what's actually available to third parties. Those are two different things.
Gentlemen, thank you. I think that these kinds of insights are hard to gather in one place, and the kind of opportunity to ask questions and share insights is fantastic. I appreciate the audience has staying power second to none. In fact, the academics in the room said, my goodness, a 2-hour session and we're well into it and you're still here. I am conscious that some may need a break, and actually what I want to do is say, if you want to quickly run out, then do it. But otherwise, I think the energy might die, and that's unfair to some people who are lined up towards the end. Next time you get to go at the front, I promise. So perhaps what I can do is just carry on. We've probably got about another 30 minutes here. We've got another short panel, and we're going to hear from an entrepreneur in the medtech space who's broken new ground, but to date funded his business on prize money and now is looking at funding. So you may be interested, and it'll give us some other food for thought.
App. Very
cool app, says Kobus. So I think I'm just going to carry on, and we're going to try to wrap this up by about 5 to 7, and that'll give you a little bit of time to swap some notes and cards and have a drink. And if you join me, please, in giving these gentlemen a warm round of applause. Thank you. Thanks very much.